Hello, sexy Saturday. Start in the United States of America with a calculated risk chart. Single-family housing starts and the unemployment rate. Now, the unemployment rate here is in red and it's inverted. So if the unemployment rate goes down, which it's doing at the moment, you see at the end of this chart in red, it actually goes up. It's inverted. But that's so we can correlate these two things. Single-family housing starts, one unit structure in blue, and the unemployment rate inverted in red. Are you keeping up? Good. 'Tis sexy Saturday. Right. The idea here, there's different ways of looking at this, but if we look at it in 1981, you see the big fat blue line up, which is the 82. Let's go 82 recession. The blue line starts going up 2 years before the red line. Yeah, the single-family housing one-unit structure goes up 2 years before unemployment rate starts going down, but is represented as going up on this chart. In the 1991 recession, 18 months before the unemployment rate starts going down, represented as up in this chart, the housing starts went up. And let's just go straight to the end. The idea here is maybe that when you get the one unit structure single family housing starts going up, a couple of years later unemployment levels will come down because this is the start of a bit of a housing boom. Along the bottom there at the end, the blue and the red are kind of wrapped around each other. It doesn't matter that one's going slightly ahead of the other. What I think this will eventually look like is just both of them just going blah, 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 along the bottom. There won't be a housing boom, and there won't be any getting out of a channel between 8 and 10% unemployment in the United States as far as the brain can look. There'll be an effort to get to 8, and then there'll be a recession that takes it down to 10. And then bounce between those two tram lines. I would have been thinking. What do we call that? Unemployment is now, is that systemic? Don't know what the word is, but I think it's going to bounce between the 8 and 10% tram lines. Number 2 is Gallup, and the Gallup poll is just another way of measuring the unemployment rate, because the official ones aren't that official, are they anyway, really? And we can see this Gallup poll obviously agrees with the more official ones, and the general trend is downwards from 2010 till now, and a start again 2011 till now. The general trend is downwards, but a nasty little kick up at the end of the last Gallup poll one. Now we can see a couple of stick-ups in the past, so this could be just a one-off, but we should bear it in mind that the chances of the Joker chart going up and meeting the zero line again, I think it's going to start flattening off, and this Gallup poll kind of helps me to say that there won't be any great going down below 8% unemployment. It will start going back up towards 9, although the United States is looking blah plus. This is from the Wall Street Journal, number 3, and it's reasonably interesting. I was quite shocked by the lowness of this number. It's 4.5%, and it is 4.5% of the labour force in the United States of America are employed in science and engineering. 4.5% of the labour force. I thought that quite a low number. That was in 1990, and it's got to just over 5, and it's bouncing around about 5 now, with a little tick down at the end, but that's neither here nor there. 5% of the US workforce is employed in science and engineering. Wall Street Journal gives us on the right of that chart percentage of US science and engineering labour force that is foreign born. Now, I'm not quite exactly what they're talking about here. Maybe these fancy little short-term that get to be longer-term work contracts. And in 1990, 10% of the science and engineering labour force was foreign-born, 16% in 2000, and it was already near 20% in 2005, and now it's over 20% in 2010. I don't know if that adds up to much, but it's something. So number 4 is our inflation, prices paid. And we can see that most of the upsies and downsies are based on the big bars, which are the gold ones. The mucky gold, which is transportation, which we'll come back to. Blue is housing, mucky red is food and beverage, blue is other, and the line, black line, is represented as the whole lot of those. The gold line seems to have come down from about February, March of 2011 and has now gone negative. I can only think that this is based on the price of a barrel of oil translated into the cost of gas at the pump. But I didn't think that price was coming down that much, so I'm really not too sure what transportation totally represents. Maybe you could look it up and tell me, but surely that's not just pure oil translated into gas, or it wouldn't have come down that far. Anyway, the CPI is obviously coming down very quickly from a height of near 4%, and now it's down below under 2%. The Fed has got it right. Number 5 is a paper, or whatever they call it. I think it's a sales document from Citi on their commodities bench and resurging North American oil production and the death of the peak oil hypothesis. It's 23 pages long, as it says here, and I would like to have gone through the whole thing with you, but that would have taken hours, and I don't think many people would have tagged along. But obviously it's follow the link and read the whole thing, but it reads to me as a sales pitch for pumping up a bubble in shale plays. The United States' long march towards energy independence, and that subheading of the United States' long march towards energy independence hasn't got a question mark after it, which points me towards this being a biased piece of writing. The concept of peak oil is being buried in North Dakota, which is now leading the US to be the fastest growing oil producer in the world, which is almost definitely true, or it wouldn't be at the head of this paper. But it's very parochial, as in small. It's not looking at the world. It's looking at the world from the view of a Citi trader who wants to sell Bakken shale play. North Dakota is a very small part of the world. That's what I've got to say. There's so much I would have liked to have dragged from this. I've almost arbitrarily dragged a few things out. 5b is the impact of the supply surge is being further accentuated by declining demand. Now, it's good that they note the declining demand, because later in this they say that oil supply in the United States going up, and the United States is importing less oil. And that's as though we are now awash with oil and we don't have to import as much. But this is a small thing, but it's important to note that in between is the fact that I've pointed out through this week that the Americans are actually using less gas at the pump now. So they need less oil. And the whole thing is kind of based on American numbers. And it doesn't wash, because the world is so much bigger than America when it comes to supplying and using oil. US gas and oil production, this is a very impressive looking chart, but I mean, back in 1970, the darker blue blocks, 11.5, that'll be million barrels a day, which is good. I mean, we're talking about, there's always the confusion between oil and liquids, but let's just say 85 million barrels a day is the world use of liquids, liquid oils. And that was 11.5 in 1970. That's an important percentage, a very important percentage of what was happening then. but you can see it's come down to under 7 in 2007, but now it's taken a little kick up to over 7. It's 7.5 now. There's a good 500,000 barrels a day that has come online since 2008, and it will be this shale oil fracking stuff. And the lighter one is gas, and there's lots, as we've mentioned, lots of they've put lots of straws in the ground and gas has exploded out. Whether that can carry on or not's a very different question. But there is 500,000 barrels a day of extra oil there, which is good. Right, is this the last one I've taken from it? Yeah, this is the last I've taken from it. But people interested in it should read it and hopefully, well, see what you think. But I think it's just a sales pitch for selling a bubble. Peak oilers, or their less bold cousins, plateau oilers, have long noted the repeated failure of the great hopes for oil supplies to really deliver. Now, keep up with this. The major supply projects often came online much later than expected, at much greater cost, and with much less oil. The production profiles tended to show sharp peaks followed by sharp declines. All of this is kind of saying not that the peak oil plateauers or oilers were stupid, it's that they were right. But apparently now, because of North Dakota, they're wrong. And I don't think North Dakota is going to make enough difference to make them wrong. Now, I don't want to put myself in the camp of a definite peak oiler or a plateauer, because I don't like tags. But I also don't like this because it just looks like a sales document. The biggest oil project globally, due to come on stream in 2012. Now, this is the biggest oil project globally. Now we're talking globally, which I like, is good. Due to come on stream in 2012. Kashagan, okay, neatly illustrates the difficulties seen in the industry and resulting bullishness on oil prices. See, they said earlier, in that top paragraph I didn't completely read, that the high oil prices that have come on over the last decade is because of the peak oil theory. And I go, no, it's not. Just people from all the way through the sales right to putting gas into the car have had to agree on the sale price. It isn't just because we're scared of peak oil that the price goes up at every stage and has gone up all through the decade. It's because that is the price that you pay, not because of a fear in the future. Anyway, the biggest oil project globally, due to come on stream in 2012, Kashagan, neatly illustrates the difficulties seen in the industry and the resulting bullishness on oil prices. Kashagan, a joint venture between Exxon, Shell and others, has been underway for 11 years. Production is due to start up in fourth quarter of 2012, 8 years behind schedule and 15 billion over budget at 39 billion total spend. Quite a lot of money, and it's Exxon and Shell, they are not amateurs, so they were doing their best. The project is scheduled to start producing 370k barrels a day, rising to 500,000 barrels a day by 2016, with a second stage expansion taking production to 1.5 million barrels a day, possibly as early as 2017, but we know it won't be, based on what's happened in the past. But what we're talking now, by 2016, not even 500,000 barrels a day from the biggest oil project globally, due to come on stream in 2000. That's to come on stream, not just to come on stream in 2012. That's to come on stream. Those are the small numbers of extra oil that are to come on stream. And okay, they might get up to 1.5 million barrels a day by 2017, if they can do it. But it's such a small amount that they're getting. North Dakota is a big deal. It is a huge deal. But we're only talking for the shale play, there North Dakota and the rest of it, at what, 2 million barrels a day by 2020, if they're lucky. That's 2 out of the rest of it that they're not finding, not getting the extra, and while the extra is not being found, all the old fields are going downwards. And what I have learned, or thought I'd learned, is that the new fields coming on, North Dakota, Kashagan and the rest, even Brazil, push that out into the future, will not keep the plateau flat because of the decline in the old fields. Anyway, it's such a big subject, it can't be done here. Let's go to the Federal Reserve Bank of St. Louis and an interesting little paper by Emmons. Don't expect consumer spending to be the engine of economic growth it once was. And quite frankly, it's 70%, and if consumer spending isn't going to cut it when it's 70%, what is? It's got to be either investment or exports. Now, I'll just throw in a quick note here. As noted in the City thing, the US is now exporting petroleum, as in gas, finished product. But it's going to be interesting to see how they make that calculations for those for exports, because sometimes they import the oil, refine it, and then pump it out again. Whether they actually take the imports for the oil coming in away from the exports of the gas going out is, I've read a few things on it, and nobody's quite sure how they account for that. Anyway, that's what GDP is. It's the difference between exports and imports, companies and others investing in new gear, stuff, and consumer spending. And consumer spending is 70% of it. And this paper definitely says that don't expect consumer spending to be the engine of economic growth it once was, and it says watch out because it'll go down. But what it's even saying is we don't even want it up, because I've highlighted this at the bottom of this graph thing, and if you go to where I've highlighted, and above it, it says X average share of consumer spending in GDP in the decade. Bottom left, you can see it's 70, where it is now. 70% of GDP is consumer spending. And across that yellow line, let's do it first, average GDP is 1.5% for that decade when it was 70%. And what this paper's saying is, well, that didn't do us much good, did it? Because the investment wasn't there. Money was going into just consumer turnover. And what you really need is money going into investment, which works out for better medium and long-term GDP. And even here, short-term GDP across the decade. The lowest decade of the lowest number for consumer percentage of GDP was 61.8% in the 60 to 70 decade, and that gave the biggest GDP read, and the others, you can have a check on them, are in between. But the lowest percentage of consumer spending in GDP gave the highest GDP average, and the highest consumer percentage of GDP gave the lowest average GDP of that decade. So what this paper is saying is that consumer spending is going to go down, but maybe it's not a bad thing. But as long as that money then goes into investment for good, medium and long-term GDP, real wealth creation. And I really want to see that, I really do. And be very interesting to see where the money does go. It'll go somewhere. Finish with this. Europe gets their shout. Greek GDP may fall substantially following potential default. Argentina in the bronze colour and Greece following. It's a bit like the Joker chart. It's zeroed before the recession or the big shit starts. And you can see how Argentina came down. The red spotty line is when Argentina defaults, and then their GDP absolutely falls well low, but then claws its way back. But look along the bottom, these are quarters, 27 quarters. So that's 4 8s are 32, 4 7s are 20. That's 7 years from start to finish for Argentina. And Greece is about 3 years in. So if Greece does default, it will be tremendously bad for GDP, probably initially, but then they might have a chance to claw their way back if Argentina's anything to go by. But Argentina was dealing in a normal world, and if Greece does it, Greece will not be acting in a normal world because the rest of the world has gone all blah. Have a good weekend. Bye.